Hello everyone, today we're gonna discuss managerial accounting on chapter 7 using variable costing and segment reporting tool management for this is using a McGraw-Hill book. Okay, let's start. Now objective number 1, we're gonna explain how variable costing differ from absorption costing and compute unit product cost using under each method. In three simplified assumptions, this chapter usually actual costing rather than normal costing approach that was used in the job costing chapters previously. This chapter always use, let me see, I'm just make sure here, use the actual number of unit produced as the allocation base for assigning actual fixed manufacturing overheads to products. This chapter also assumed that the variable cost per unit and total fixed overhead cost per unit remain constants. Okay. Overview of variable and absorbed costing. This is the variable costing in terms of product cost, which is like materials, like labor, and variable overhead. Okay. And then in terms of the period cost will be fixed manufacturing overhead, variable selling and use expense, selling and use expense. This is for variable costing. For absorption costing, however, it's going to be additional fixed manufacturing overhead here. Direct labor, direct materials, direct labor, variable overhead, and fixed manufacturing overhead. Period cost will be only two. So you see the difference here between absorption costing, variable costing. The difference is in this particular fixed manufacturing overhead. Okay, in the variable costing, period cost will be included in fixed manufacturing overhead. In absorption costing, this part is going to be in product cost. Okay, which method will produce the highest value for work in process and finished goods inventories? A. Absorption costing. B. Variable costing. C. Produce the same value of this inventory. D. It depends. Either A, B, C, or D is your answers. Which one do you choose? Take a moment. 1 or 2 seconds, 3 seconds, 5 seconds, 6 seconds, 7 seconds, 8 seconds, 9 seconds, 10 seconds. So what's the answer, guys? Alright, this is the answers, which is A. Absorption costing proceed reduce the highest inventory values because it treats fixed manufacturing overhead as product costs. Under variable costing, fixed manufacturing overhead is expense as incurred and never becomes a part of the product cost. Harvey Company, again, unit cost computation part 1 here. Harvey Company produced a single product with the following information available. Number of units produced annually is 25,000. Variable cost per unit is like materials, like labor and variable managing overhead cost is $10. Selling and expense is $3. Fixed cost per year, which is managing overhead, is 150,000. Selling and expense is 100,000. Unit production using absorption costing is going to be like this. Absorption costing going to be $10 here. Variable costing will be $10, but the figure of overhead will be $6 here on using absorption costing, but variable costing will be zero, $10, because we included in the unit product cost using absorption costing. Under absorption costing, all production costs, variable and fixed, are included in when determining in unit product costs. Under variable costing, only variable production costs are included product costs. Okay, so this is where the big difference is. Absorption costing including manufacturing overhead. Learning object number 2, prepare income statement using both variable and absorption costing. Let us assume the following additional information for Harvey Company. 20,000 was sold during a year, price is 30,000 each. There is no beginning inventory. Now let's compute net operating income using both absorption and variable costing. Variable managing cost is $10 times 20, which is 200,000 here. You got a sales 600,000. Variable selling and expense with 220,000 3, you got 60,000. You got 260,000 total. Variable expenses contributing margin 3 of 40. Well, all fixed management overhead is expense here. That's a division 150,000. Fixed assets is 100,000. Total is 150,000. And income will be 90,000. This is all variable costing because the fixed manufacturing overhead is expense. That's the big difference there. Okay, in the variable costing system. For the absorption costing, however, income statement, you got the sales 20,000 30, you got 600,000, cost of goods sold 20,016 because you need using an absorption costing, you include the managing overhead there. Okay, so you got 320,000, gross margin of 380. Let's say this expense variable 20,000, 60,000, fixed is 100,000. Operating income will be 120. Fixed margin overhead deferred in inventory equal to 30,000, which is 5,000 units times 6. In running object number 3, reconcile variable costing and absolute costing, the net operating incomes, and explain why the two amounts differ. Okay, this is look at the comparison of the two methods. CGS, absorption costing, will be 320, and the inventory is 80,000. Cost is 150,000 because you got 120 here, 30,000 here, you got 150,000, but in variable costing will be period expense. You see the difference here. Okay, guys, this is the difference between absorption costing and variable costing. Variable costing, you're going to expense it out as in a fixed margin overhead. Topic number 2, we can reconcile the difference between absorption costs, absorption and variable income as follows. Variable costing operating income, which is 90,000, add fixed income and overhead, which is 30,000. Absorption costing will be 120,000. Fixed margin overhead will be 150, divided by 25,000 will be $6 per unit. Okay. Number of units produced, which is 35,000 as discussed. Number of units sold is 30,000, beginning with 5,000, units sales is 30,000. Variable cost per unit, which is 10 plus 3. This is direct labor and overhead, which is $10. Selling and expense is $3. So fixed costs per year will be 150 for marketing overhead, and selling and expense will be 100,000. Using absorption costing, you're going to add $6 here, you got 16 here, variable only $10. Okay. Since the rate cost per unit, total fixed cost and the number of units produced remain unchanged, the unit cost computed also remains unchanged. Okay. Let me get a sip of water here. Alright, let's continue. Variable management cost will be $10 here. Less variable account cost in variable costing, okay, 30,000, 300,000 here. You got sales of 90,000, variable expense 90,000, total variable expense half 390,000. The CCM contribution margins have 10,000. But remember, variable costing, it will be expense it out 150,000. Fixed expense 100,000, so 250,000 here total. Income will be 260,000. This is the difference here, okay? For managing overhead, and you get a variable cost, managing cost only. In a subsidy costing, however, it's different way. CGS will be times 16, 480, gross margin 420, you got 230,000 here. This is what the unit cost of product cost included. With margin overhead release for inventory with 5,000 times 6, which is 30,000. So reconciling the difference between absorption and income will be as follows. Variable costing on net operating income with 260, deduct fixed income margin overhead 30,000, we get 230,000. So mixed margin overhead will be 150 divided 25,000 will be $6 per unit. So in terms of the first period, for using costing method, absorption is 120, second have 230, we get total 350, variable with 90,000, second period 260, 350. It will reconcile the difference, just a matter of where you allocate your manufacturing overhead cost, but eventually it will be the same. Okay, that's the difference. Summary insight. Relation between product and sales, unit produced equal to unit sold. Affecting inventory, ratio change in inventory, relations between variable and absorption cost. Absorption equal to variable, unit produced greater than unit sold, inventory increases, absorption greater than variable. Unit produced here, unit sold, inventory decreases, absorption less than variable. Variable costing, calculate cost as variable, fixed, so it is much easier to use this. Is income statement format in ZVP analysis, cost volume price analysis, because the absorption costing assign fixed managing overhead costs to unit produced for $6 of Harvey Company. Portion of fixed managing overhead reside in inventory. When the unit remains unsold, the potential result is positive operating income. when the number of units sold is less than the break-even point. So what is the variable costing? It's only affected by change in unit sales. It is not affected by the number of units produced, okay? As a rule, when sales goes up, net operating income goes up and vice versa. Okay, and going up and going up for operating income and vice versa, going down, going down. Observed costing, however, is influenced by changes in unit sales and unit productions. Net operating income can be increased simply by producing more units, even those units are sold. In supporting decision making, variable costing identify the additional variable cost incurred to make one more unit, $10 per unit of every company. It also emphasizes the impact of total fixed costs on profits because association costing assigns fixed managing overhead costs to unit produced. It gives the impressions per unit of to a Harvey company. It gives the impressions that managing overhead is variable in respect to the unit produced. This result can be inappropriate in pricing decisions and product discontinuations decisions. Okay. In terms of learning objective number 4, you need to prepare the segmentation of income statement and differentiate between traceable fixed costs from the common fixed costs and use it to make decisions. A segment will be any part of an organization about with the which manage costs, revenue, and profit data, individual source, service center, and sales territory. So there are two key elements in building the segmented income statement, and contribution format should be used because it's separate fixed from the variable costs and enable to calculate the contribution margin. The traceable fixed costs should be separated from common fixed costs to enable the calculation of segment margin. Traceable fixed costs arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. Example of traceable fixed costs include the salary of Fritos product manager at PepsiCo is a traceable fixed cost for the Fritos business segment PepsiCo. Okay, fixed cost that is traceable here. Also, the maintenance cost of a building, which Boeing 747 assembled, is traceable fixed cost of the 747's business segment in Boeing. The common fixed costs arise. Example of fixed costs include the salary of CEO of General Motor, is the common fixed cost of the various divisions of GM, and the cost of heating a Safeway or Kroger grocery store is a common fixed cost of the various departments. Okay. Why it is a common fixed cost is arise because the overall operation of the company would not disappear if any person were eliminated. That is the definition of common fixed cost. Okay. You need to understand the definition here. Common fixed costs. Example provided is two. One is the salary of CEO, the second one is the cost of heating. Traceable fixed cost is important to realize that the traceable fixed cost to one segment may be a common fixed cost to another segment. Example, landing fee paid to a lane in an airplane at an airport is traceable to a particular flight, but it's not traceable for first class, business class, and economic passenger class. Okay, landing fee. Alright, let's look at the next one, which is segment margin. Is computed by subtracting the traceable fixed cost to a segment from its contribution margin. It best gauge of the long run profitability of a segment. Fixed cost is traceable here, and don't all common cost to a segment. Okay, this is not the fixed cost. You only use the traceable one. It's common CEO common salary, and then the heating costs. Okay. Segment market has two divisions. Example, computer division, television division. Look at the more closely at the television division income statement. So we're going to look at this statement. Okay, approach. This is for the television division. 300,000 shares, CGS 120. Other value expense 30, total 150, contribution 150, traceable fixed cost 90, division margin 60. So CGS consists of variable manufacturing costs and fixed costs consist of other fixed and variable costs that are listed in separate function. There you go. In terms of television division, contribution is computed by taking sales minus variable costs. Segment margin is television contribution profit. Okay, so look at this logic here. Company, television, computer. In detail, you got division margin 100,000. 60,000 coming from television, computer 40,000. The common fixed expense should not be allocated to the divisions This expense would be remain if one division were eliminated, which is the 25,000 here, common expense. Okay. As previously mentioned, fixed expense that are traceable to one segment can become common fixed expense if the company is divided into smaller segments. Let's see how this works using a example here. Product lines such as regular and big screen for television department. Income statement will be regular and big screen. Product line margin will be 60,000. Big screen will be 10,000 production margin. The contribution is 105,000 here for regular. Big screen will be 45,000. But remember, traceable here 80,000 fixed cost. And then another common action 10,000. Total will be 90,000 for those television department. Okay, once a company prepare contribution margin, segment income statement, you can use the statement to make a decision and perform break-even analysis. So we're going to perform break-even analysis here. There's an increase, 5% increase in sales. Okay. And then you got the contribution margin here, margin increase by 5250 here for regular, margin increase by 2250 for the big screen. You got a common expense additional 5,000 here, advertising division increase by 2,500 compared to the previous one. Okay, this is the previous one. Okay, look at this. This is the previous one, the previous slide, and this is the next slide that shows you the difference. Okay, 15,000. There's an increase here. 5,000 at advertising cost. There's a division margin increase by 2,500. There's a margin increase by 5250 for regular, and big screen will be 52250. Okay, assume. Okay, this is the thing. Assume we believe that spending 5,000 additional advertising will increase in the television division sales of a regular and big screen television by 5%. A 5% increase in sales increases the segmented margin for regular television by 5250 and segment margin of big screen television by 2250. Subtracting 5,000 in additional advertising as a common expense result in division margin increased by 2,500. Okay. Objective number 5, compute company-wide and segment break-even analysis for company with traceable fixed costs. So this is the logic here, the first logic. Okay, you got television division margin 60,000, computer 40,000, common expense 25,000. You're gonna total it up coming from these two, and income operating will be 75,000. And you're gonna calculate the wide break-even analysis. When you do that, this is the logic. Break-even point 170 plus 25 divided 0.54, okay, which is 361. Contribution ratio will be 270 divided 500, which is 0.4, which is this one. Okay. Company break-even point is computed by dividing the sum of the company traceable fixed expense and common fixed expense by the company overall contribution margins. Okay, this is the one. Okay, we're gonna go back. Excuse me. This 125. You're gonna go back and look at the slide. 170 here, 25,000. You get the break-even analysis in each segment. When you calculate break-even point for television, 19 divided by 50, which is 0.5, you got 180,000 here. Contribution margin 150 divided 100,000, which is 50. For computer, 80,000 divided 60, which is 0.60 here. You got 133,000. Contribution ratio will be 120 divided 200. Okay, you're gonna look at this detail in the next slide, so you can see an idea where it's coming from. Okay. Okay, note that 25,000 common fixed expense are excluded from the segment break-even calculation because the common fixed expense are not traceable segment, are not influenced by the segment level decisions. In terms of mission costs, costs assigned to segments should include all costs attributed to the segment from the company entire value chains. In terms of business function, making up the value chains such as R&D, product design, manufacturing, marketing, distribution, and customer services. So in terms of upstream and downstream costs, since only manufacturing costs are included in product costs under absorption costing, this company can choose to use absorption costing for segment reporting purpose and will omit from the profit analysis all upstream and downstream costs. Okay, what is upstream costs? Include research, development, and product design costs. Downstream costs include marketing, distribution, and customer service costs. Although these upstream and downstream costs are non-monetary costs, they are just as essential in determining product quality as the margin cost. Omitting the number analysis will result in the underscoring of the product. So failure to trace cost directly can be traced like to specific variant to a company should not be allocated to other segment. Inappropriate allocation base, some companies allocate cost to segment using a big case. Cost should be allocated to segment only when allocating base derives from a cost actually being associated with it. Common cost should not be arbitrarily allocated to segment based on the rationale that someone has to cover common cost for two reasons. This practice make profitable and the business may appear to be unprofitable. The common fixed cost was made to be held accountable for costs that cannot be controlled. Example is going to be given to you here. Bar is 14,000, restaurant segment is 230,000, common cost 200,000, and profit 44,000. Assume our lecture prepare its segmented income statement as shown below here. This is what is assumed. So let's look at how much common fixed expense. Totals can be void by anything the bar common expense. Okay, limit. What's your answer for that? Okay, A, none of it. B, some of it. C, all of it. Okay, give a 5 seconds to answer. The answer will be A, none of it. Common fixed expense cannot be eliminated by dropping one of the segment. The second one, suppose square foot is used by the basis for allocating common fixed expense of 200,000. How much will be allocated to the bar? If the bar occupies 1,000 square feet restaurant 9,000 square feet. So the answer will be, give 5 seconds and you get the answers. 20,000. Let's get 110, 1,000 divided 100, 1,000 plus 9,000 square feet. Total will be 20,000 times 10%. This is how you get the 20,000 coming from. Okay. Concept check 2. If Holland allocates common fixed expense to bar, what would the reporter reach profit? Prefer financial statement. So the financial statement will be like this. Bar will be like this. Okay. Bar will be losing 6,000, restaurant will be 50,000. So what is above? So the bar be eliminated? Yes or no? The key part will be what? Bar or restaurant will be eliminated? No. If the bar eliminated, the company net operating profit will decrease the bar, okay, by 14,000. In other words, the company net operating profit will decrease from 44 to 30,000. So bar should not be eliminated. Both US GAAP and IFRS require absorption costing for external reports. Remember this. US GAAP and IFRS, they agree to absorption costing. So US is the only country that do not use IFRS so far for this year. Since absorption costing is required for external reporting, what company also use is internal report rather than including additional costs for maintaining a separate variable cost system and internal reporting. So absorption costing is where the fixed management cost must be assigned to product to properly match revenue and pro cost, while variable costing, fixed management costs are capacity costs that will be incurred even nothing is produced. So, both US GAAP and IFRS require public traded company to include segmented financial data in the annual report. Company must report segmented results to shareholders using same method and that are used for internal segment report. This requirement motivates many to avoid using contribution approach for internal reporting purposes because they did not would. Because if they did, they would be required to A, share sensitive data to the public, and then consolidate report with legal rules for the consolidated reporting purposes. So this basically concludes this chapter. This chapter comparing between two approaches. Okay? Alright, that is the end of this chapter. Hopefully we can see you soon in the next following chapter. And it's going to be available in NetPuzzle as well as YouTube, so you can use it as your practice for managerial accounting. Thank you. Bye-bye.